Dominic Rossi, Global CIO Equities at Fidelity Investment Management, joins us from London with his views on the Indian market. Dominic oversees equity assets worth $172 billion. Dominic, great to have you on the show. Thanks very much for taking out the time to speak with us. What's your initial reaction really to the exit poll numbers? I know sitting out of London you might be looking at this event a bit objectively. But what's your overall view on what the exit polls have had to state about the Indian election results, and also how do you tie that in with your India market outlook?
I think the first thing I think we all know is that we should always put a word of caution on the exit polls. We've known from previous elections that those exit polls have not proven to be absolutely reliable. So I think between now and the actual outcome of the result, I think I have a certain caution. But nevertheless, if we do take the polls at face value, I can understand why the positive momentum of the market has continued. There were some fears, I think, prior to the exit polls that Modi might end up with maybe 200 to 220 or 30 seats, and therefore a dependency on allies would become a greater force in government. I think now we're talking about potentially seats of more than 240 will certainly strengthen the new Prime Minister's hand. So it does make sense that the market is looking fairly positively at this juncture. What I would say, though, and this is a further word of caution, is that often in these situations we find that markets buy on the rumour and sell on the news. As the market moves away from speculation over who would win and what would and what the government new government would look like, and move to the actual implementation. And I think at some stage over the next few weeks, the market will move from the fiction to the reality of a new government, and then start asking hard questions about the reform agenda, and that may cause some kind of a pause or sell-off in the index, which has obviously moved rapidly over the course of recent weeks.
Right. How do you look at the macro situation then for the Indian economy at this point in time, and what will be the key drivers for the Indian market going forward?
I think we all know the potential positives for the Indian economy and the Indian market, the consumption story, the demographic story, but I think the real obstacle to the Indian market remains the need for structural reform in a whole host of areas of the economy: the financial sector, the fiscal sector, labour markets, and the regulatory framework around infrastructure investments. And I think it's when the markets get confident about the new government's approach to those fundamental issues that we will be in a position to take this bull market to the next level. If the market gets a sense that the government may backtrack on some of those reform ideas, then I think the market will reverse.
Dominic, afternoon. Let's work with the best case scenario that we have a stable government and it doesn't backtrack on reforms. During the course of the year, do you think the market can extend its rally and remain expensive, because there will be significant amount of money globally that could flow into a stable, large emerging market economy?
I think that's possibly correct. I think the way that we look at the emerging markets today at FIL, and how we choose between emerging markets has changed over the course of the last 2 or 3 years. Today, when we're looking at emerging markets, be it India, China, Mexico, Russia, Brazil, the first question you really have to ask is, how serious is the reform agenda? And in those countries where the reform agenda is serious, I think those equity markets will continue to progress. I put Mexico in that category. I am increasingly thinking that I'll put China in that category, and I would very much hope to be able to put India in that category as well. Countries which I most certainly can't put in that category today would be Russia and Brazil. And I think within emerging markets over the course of the next few years, or have already seen it in truth over the course of the last couple of years, is a bifurcation of performance between those that are serious about reform and those that aren't serious about reform. Because the old model, the export-led model to growth, which worked so well during the last decade and up until about 2000 and until the financial crisis, indeed, that model of development really has passed its sell-by date, and now emerging market country after emerging market country is having to search for a new economic model, and that the premise of that new economic model is about domestic activity, domestic consumption, and in particular domestic structural reform.
My question, Dominic, particularly is that if India remains an expensive market, would you, as a money manager, still be tempted to buy into India at all levels, assuming a stable government and assuming reforms?
I think that's correct. I think that is correct. And I'll inverse your question, if I may. How do I feel about emerging market economies and markets which look particularly cheap? My view is that those are likely to prove to be value traps, because those countries are cheap for a reason. They're cheap because they're not serious about reform. And I think we will see this bifurcation in performance. I think that is already being reflected in valuations, and I think the mistake in emerging markets may be to buy the cheap ones.
Right. Dominic, I see that your India exposure across your funds is roughly about 6%, benchmarked to the MSCI. Is that exposure under review at this point, given the outcome from the elections?
To be honest with you, our fund managers are reviewing those exposures every single day. So I don't think our approach to managing money is likely to change, nor do we asset allocate funds to markets in the way that you might expect. My job isn't really to take billions of dollars and direct them to India versus China or vice versa. We give quite a lot of freedom to our fund managers to pursue their views. Sometimes they differ. So it's not really appropriate to focus on a certain level, 6%. Will it go to 8% or 9%, or will it go back to 4%? But certainly today's developments and the fact that it looks like we do have a government with a sound majority, with a position, if it chooses to drive through structural change, is one that we would view as positive for the long-term outlook for the Indian market.
Coming on the heels of the election results will also be, as we just discussed, a turn in macro activity, a turn in the economic cycle as well. What is it that you're projecting in terms of growth revivals for India particularly?
I think that, sorry, my mic is beginning to lose sound. I think that we've seen some improvement in macro fundamentals in the Indian economy over the course of the last 12 months or so. And I think that will continue. However, I still think that India is in danger of a boom-bust cycle. We've seen that over recent years, but the persistence of high fiscal deficits, low productivity, and persistently high inflation rates means that India is unlikely to enjoy a prolonged period of economic growth, sustained non-inflationary growth, without the structural reform. So it's difficult to answer your question without continuously going back for the need for that reform.